One of the things I love to do at one rental at a time is introduce new faces and new voices with new stories. We're going to learn about a young man, Ulysses, who was very gracious, very kind, and very helpful here recently on X or Twitter when I stuck my nose into something called FHA delinquencies. It was my initial impression that there's no chance in hell that delinquencies are worse today in 2024 than they were in '08. Ulysses was very kind in basically saying, you know what? It was. And that's because we are dealing with a sliver of delinquency. So, as I admitted yesterday on the Daily Financial News, gave full props to Melody Wright for highlighting correctly that FHA delinquencies are far worse today, not only in percentages, but in absolute numbers. Ulysses was the young man who put together the chart and really helped me understand, yes, it's worse, but we are not talking about the entire mortgage market. So Ulysses, thank you very much for helping somebody who was who's not deep in the mortgage area, not deep in origination, understand that we were simply talking about a sliver. Thanks for being here.
You're most welcome. Thanks for having me.
Awesome. So again, this was really our first interaction. You were gracious enough to help say yes to this invite. So why don't you introduce yourself to my audience, who you are, what you do in this real estate game, what you've done historically, and what you're doing now.
Sure. So my name is Ulysses Awesome. I have a company called U.S. Property Services and provides real estate consulting as well as construction management. Also have a company called All Pro Framing, where we provide framing labor. You'll find those crews on job sites for companies like Lennar, basically track building. Awesome Associates, which is a family firm that has been in business since the mid 1990s. That's asset management, real estate development. So I have been around this majority of my life. Developed properties early in the 2000s. Did a stint doing some film production work on the movie theater. That was post GFC. But today, now, the other thing that I do is I'm also the real estate analyst for Macro Edge Research. And so that really allows me to satisfy the data junkie in me, to analyze data, get the information out there to people.
Very, very cool. So I always like, because again, there's so few of us that started real estate investing pre-GFC, got into the fire, came out the other side, and kind of rode the wave. Because hey, if you got started in real estate 2012, you've only known one market, right? Kind of
Sure.
up into the right. So I guess the first thing to kind of talk about for me is when you look at the real estate market today, either residential or commercial, does it feel like anything that we saw back in the GFC, maybe '05, '04? I mean, are there any similarities in your mind?
Yeah, definitely. I think we just experienced some similarities from '03 to '05, '06, which
Yep.
we had a rampant run up in asset pricing.
Yep.
We had, very low rates at the time as well. And I think we just went through that. And I think the other thing that is similar to leading up to the GFC is just the rate of slowdown.
Mm.
I think a lot of times it gets miscategorized that it was sort of an all of a sudden just fell off the cliff, but it really was a couple years of, you know, almost no growth, but a little bit, then a little negative, then a little bit more growth. Really, it was a
Yeah.
rough couple of years there for people.
Yeah. One of the things that I remember about that environment, so we're going to talk pre '08, um, was just the amount of home builders,
Yes.
right? You had lots of mom and pop or smaller ones. It wasn't only the big boys, right? And
Correct.
everybody seemed to be doing these large track homes, right? A small one was 50, right?
Yeah.
They were just building, building, building. I don't know, we didn't really get back to that, right? The building that we saw '04, '05, '06 never really materialized, right? We had some infill guys, we had the big boys doing stuff, but we never had that kind of second tier. Is that a fair thing to say?
I think that's actually not accurate. I think
Okay, cool.
we have actually, if you're talking about overall residential construction,
Hmm.
over the last 3 years, we built more housing units than at any recorded time in U.S. history.
Really? Awesome. Okay.
A good chunk of that has been apartments. As of
Okay.
last
Well, yeah,
year,
yeah. So
we peaked,
units, you're talking housing
right,
units, not
right.
single families.
And single family at its peak in 21, 22, we built almost as much single family housing as we did pre GFC,
Okay.
I think. And we did have a lot of smaller builders this time around, but it was not like what it was before. One
Yeah.
of the things that happened post GFC was consolidation. Um,
Yes.
you had Lennar and D.R. Horton becoming
Just gobbling up.
megaliths.
Yeah.
Yeah, I mean,
Yeah.
D.R. Horton sells more houses in a year than uh, almost, outside of Pulte and Lennar, almost all of the other publicly traded builders combined, or
Combined. Yeah.
the 20 builders. So that's how big DR is, and Lennar is not too far behind.
Yeah. Yeah, that's what I was referring to, single family homes, but that's an
Sure.
interesting idea. If you just talk housing units, right? Dwellings, which would
Yeah,
obviously be multifamily and apartments. Um, that is, you're absolutely right. When you talk about dwellings, we have delivered or are soon going to be delivering more units than we ever have,
right.
which is going to be very interesting dichotomy, right? Because I do think the multifamily, certainly the Sun Belts, is or will be seeing soon declining rents,
Sure.
right? Just it's the only way you can. It's the only way you're going to fill this up with all the competition.
Right.
And yeah, I think that's coming. If it hasn't happened already, it's on the horizon and it's pretty close.
Yeah, definitely. In August, according to Survey Construction, we delivered the most amount of apartment units since 1973. Basically,
Wow.
there's 4 months in 1973. They were the only months we delivered more. So if we continue at that elevated pace, then yeah, we'll probably set some records.
Yeah.
You
So
know,
let's play with that a little bit because again,
yeah,
I this is not my area. I'm not a commercial guy, but I do pay
sure.
attention to it. Um, if so, right now it does seem like a lot of these projects that are quote unquote delivering, they were
Mhm.
started years ago, right? They were started in the ZERP environment.
Yeah, there's a
Uh,
good chance they were. If you talk about like anywhere from a 30 to 60 unit apartment building, construction can last anywhere from 8 to 16 months. Um, there were a lot of project delays in the environment where things
yeah,
were inflating.
yeah,
Uh, you know, that kind of demand created, a natural supply shortage, and then we had uh, other issues that compounded that. So you were seeing stretched out construction times. Those times are closing. And so I do expect that we're going to see more elevated completions over the next few months. But
yeah,
either way, we're talking about out of the ordinary, delivery of apartment supply.
yeah. Sort of all coming to market together is never a good sign, right? When you
Correct.
when you throw a bunch of supply on the market, it
Yeah.
just you
I
you,
guess
you know it's
it depends on, which side of the coin you're on.
true. Yeah, fair enough. Tenants are going to love it because it'll be a race
Yes,
to a
yes,
bottom,
true.
right?
You might get a
Yeah.
discount on apartment in the near future. So,
Oh yeah, you're going to get. I mean, I remember '05. The only way you get people in is 1 2 month supply. Half off
right,
deposits. That's going to happen. It'll be a competition. But
definitely.
if you were to step back from that picture, it appears to me again as an outsider, sometime last year, a lot of projects that were in the pipeline
Mhm.
got canceled. So
Sure.
while we're delivering more units than a couple of months in 73, that will continue for months to come. There will be an air pocket at some point in the not too distant future. Is that reasonable?
Yeah, I do think so. And I think that's where a lot of the things that I've shared through MacroEdge, or sometimes you get labeled doomers, uh,
Hmm.
because I think the natural effect of that is if we've got a pocket where now we don't need to build as much, or people are reeling from absorbing the supply,
Hmm.
uh, that's not good for construction employment. Uh,
No,
and we're
absolutely
not
not.
we're not cheering that on. We're just pointing out, these are natural things that occur when people pull back on development. Employment suffers.
Yeah. I've never asked this question because I didn't know anybody that would know this answer. You might, you may not. When you look at the construction labor market,
Sure.
you have a guesstimate of how much of that is commercial, i.e., putting up, multifamily commercial stuff versus how much of that's residential stick framing. Is it
Yeah.
70/30? I mean, I have no idea.
I don't recall the exact statistic, but it is more residential than it is
Oh, interesting.
commercial. Commercial spending gets more, but um, for whatever reason, we have and pretty much always have a more efficient market in the commercial world than the residential world.
So I just want to make sure I understood that correctly. Today, there's more labor bodies working in residential than commercial, kind of in
Correct,
total. Okay.
correct.
All right. Like I
And
said, no
that could be
idea.
broken down into the type of work as well, whether it's finished labor,
Yep. Just
foundation
stiff
work,
framing,
yeah,
foundation. Yeah.
highway, that sort of thing too. Census
Okay.
district, all that. So
All right. Again, these are things I don't know. I'm trying to learn. Is it fair to say that there is some transferability if multifamily construction labor falls 15%? Some, if not all of that, could be absorbed in residential if we got on a
sure.
residential kick.
Yeah, that is, in fact, there is an enormous crossover already in the apartment um, world and residential, single family. Um, our crews do that. We go back and forth from apartment project to single family all the time.
Makes sense. Yep.
Uh, and there is convertibility. One of the things that a lot of people did during GFC or post GFC, when the residential construction employment sort of disappeared, a lot of people went into the commercial side because there was
Yeah.
still commercial work. You've got Fortune 500 companies that they're planning, years out on build
Mhm.
timelines or renovations. And so a lot of that work got people through because they jumped from residential to commercial employment.
Okay. Yeah. Because it'll be very interesting to see. Because again, something I believe, and again, you're in it, you're in both sides. So tell me if my opinion is wrong. I think a lot of people think real estate is
Mhm.
one cycle, right? Residential, aka commercial. And having been in it at least as a buyer and a seller, right? Never a builder,
Sure,
they're not the same, right? You could have a peak in residential right when multifamily is bottoming, i.e., 2005, six.
sure.
I jumped out of singles into multifamily, took all
Oh,
this
okay,
fake equity and moved it into a depressed asset. So
sure.
I think that might be coming, that opportunity might be in my near future again.
Yeah, I would agree. The cycles, I tend to track it as the mortgage cycles, right?
Okay.
As credit is expanding, that's basically the business cycle. As credit is contracting, that is also the business cycle. Uh, you
That's
saw it
awesome.
in the 90s. The commercial real estate crash happened from basically 87 to 94, 95.
Mhm.
Commercial buildings, I mean, cities were giving them away for $1. I personally
Yeah.
know lots of people that acquired them for $1, redeveloped them.
I do too. I know somebody built their portfolio in New York City of all places, bought
Sure.
several buildings for $1, but they
Yeah.
had hundreds of thousands of dollars in
Right.
investment. So, yeah.
And that's where a lot of today's, I think, when you think of people talk about boomers having wealth, there's a lot of opportunity that was created there for them, and that's where a lot of it
Yeah.
came. So it wasn't in any environment like we're facing right now. It was a totally different opportunity. But
Yeah.
residential suffered for a couple of years, but it wasn't like commercial. Commercial took a
No.
lot more time to come back then. And
Yeah.
then even .com, residential didn't suffer very much, whereas
Mhm.
commercial, it was rough. A couple of years there was rough
It was
after
rough. Yeah.
.com bust. Yeah.
Yeah. So let's talk about lending because again, I think, having been in environments where lending is very loose, to environments where you can only get
Yeah.
4 loans, right? Yeah, I've seen a lot.
Yeah.
Um, when I think about the most unhealthy residential lending environment, I always go
Mhm.
back to 2006,
Yeah.
2005, 2006. We had just a couple of years of booming growth. That's when everybody was just, that was when the big short stuff was happening.
Yeah.
Dogs were getting loans and, all this crazy stuff. Um, I didn't see any of that craziness even during the pandemic. I think the lending
Sure.
standards, the lending environment of the last 3 years has nothing on '05, '06. But you're in it. What do you think?
I wish I could agree with that.
Oh, awesome. I
I think,
disagree. Cool.
yeah, one of the great things about The Big Short is that a lot of people understand some of what happened.
Yeah.
I think one of the things that it gets wrong is the real estate side of it, and that it was all about, the guy's dog owning the house,
Yeah.
or people getting
3
what's it?
loans and yeah.
Yeah,
Yeah.
three
Yeah.
loans, right? You're talking
Yep.
about. Yeah,
The
three loans
strippers.
on one house, right?
Yeah, 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 yeah,
Uh,
yeah.
but I have seen a lot of the same thing going on. In
Okay,
fact,
awesome.
I was at LGI Homes for the run up
Mhm.
21, 22, and some of the loans that were being approved, I just I cannot believe that they happen. Uh,
Okay.
and those were some of the best sales years that
Yeah.
single family development has had in a long time. And then the Philadelphia Federal Reserve authored a study where they said that roughly 50% of investment loans are, or 50% of the investment loans have committed owner occupancy fraud.
Oh, let's
And
break that down. Okay. Yeah.
so that would be similar to somebody's dog owning, right? It might not be that extreme, but it would be somebody that maybe buys a single family home,
Hmm.
gets the loan saying it's going to be their primary residence, but it's not. It's
Yeah, it's
actually
an
an investment.
Airbnb or a rental or
Right, right.
whatever. Yeah, yeah. So they never
Which is
occupied. So that
correct.
again, that's fraud, right? You
Yeah,
sign. I don't know I don't know if we did that back in the day, but certainly recently, you're making a declaration on your loan doc, but that's going to be an owner occupied loan, right?
correct.
Rates are different, right? If you check box investor,
Oh,
rates are higher,
yeah,
down payments
absolutely,
higher.
absolutely.
Absolutely fraud.
People were able to get, I mean, some of the greatest long-term money for a single-family mortgage in 2020, 21, 22.
Yeah.
Well,
Sub
I would
three.
argue the greatest that I know in existence, right?
Yeah.
We probably go
Yeah.
back centuries and it's still not as good.
I haven't
But if
seen it.
you
Yeah.
if you do that as an investor, it's entirely different.
Yeah.
And I,
Point, at
you
least
know,
a
I'm
point
sure,
higher.
right, had clients doing the same thing, bought some houses during that time or around that time, and 3 to 4% interest higher rates than
Mhm.
if it was a primary residence.
So
So there's
so
that,
this is fun. I love this.
and
So
then
again, when money gets hot, real estate, all of that fraud comes in. I love the fact that we're talking about fraud in this cycle because again, it's not an area that I look at a lot.
sure,
So so what I think you said, so I want to get a feeling for size, potential size.
yeah,
So you have a rough guesstimate about how many loans were originated in, let's say, 21 or 22? Are we talking 5 million, 6 million? I have no idea. Just a
it's.
round number.
I want to say it was 5 or 4 3 trillion, 4 trillion in 21 and 22. I don't have the exact numbers.
So let's
I'm
just call
looking
it
at
5 million because I think it's going to make me play with these
sure.
numbers better. So 5 million. Now, in the pool of 5 million, you will have the largest percentage of those will be owner occ, but you will have some investor loans because all of that
Correct.
is in one pile, correct?
Yep.
So let's call it 80% owner occ, 20% investor.
Mhm.
Fair? So okay,
Sure.
a million goes away. Now we have 4 million. So what I think I heard you say is somebody ran a report where potentially 50% of the 4 million might be fraud, where they said they're going to be
Sure.
owner occ, but they're investors. Is that what I heard you say?
Yeah, and I'd have to pull this up because I'd like to use the accurate numbers.
Okay.
But it was 50% of originations. And I'd love to send you this report because it's actually a pretty interesting look at just some of the
You
practices.
want to share it or you want to send it to me? What did you say?
Well, I'd like to send it to you and see if I
Yeah,
can pull it
please.
up here while we're having a conversation as well.
Yeah, because I think this is important, right? I had no idea because let me just say this. I knew with certainty that there was fraud going on, meaning I'm
Sure.
going to buy an owner occupied house on the lake. I'm going to live there because I can work from home. You're lying ass. That was an Airbnb from day one. Stop
Yeah.
lying. I had assumed again, if we're just going to use round numbers, there was 4 million of owner occ loans.
Sure.
I, again, complete naive. I would have guessed the amount of fraud in that was hundreds of thousands, 100,000, 300,000. So anywhere from what would that be? 10% to maybe 15. The
Sure.
fact that it could be as high as 50, that's a different problem.
Yeah, no doubt. I found this. I'm just looking for the issue, but even during GFC, we're talking about roughly 5% of loans and housing, 5 to 7% going bad, and look what kind of damage that was. So even a small amount can make an enormous difference, depending on how
Yeah,
things
so
are.
let's talk about that a little bit, because I think that's a very interesting thing. If we now learn that fraud is on a scale that's 2 or 3x bigger than I thought, right? We don't have real numbers, but let's just say two or
Right.
3x bigger than my natural brain thought. The other thing that I look at, again, having experienced the crisis last time, was forced selling,
Sure.
right? Last time, again, we had a lot of forced selling after loans reset. I
Right.
believe I looked at a number, I think it was '06, it might have been '05, where 51% of originations were ARMs. I don't think we ever got close to a number like that in 21 or 22, but again, maybe I'm wrong. I've been wrong several
Yeah.
times so far.
No, one of the things that is really, that's a commonly known part, right? And that's one of the things that I would wish that the Big Short maybe had paid more attention to, because a lot of the arms came, post uh, rate raises in '05, but people were already having issues with loans prior to that. And part
Correct.
of it wasn't just the rates reset, but they were the rate at which that they were qualifying, their debt to income levels were
Oh,
high, right?
we're
Above
terrible. Yeah.
30%.
Yeah.
And HUD defines 30% as affordable housing, right? So traditional lending standards, 25% debt to income. So a quarter of your monthly income
Mhm.
can go towards loan qualifying. And then HUD just says, well, we'll just let you take 30% because we want,
Yeah.
to be affordable.
We want
And
to give
that's
you a
what
loan.
affordable
We
housing
want housing.
is. Uh, but then we have the same thing going on now. One of the things that I did, so we have the housing mortgage data that's available through Consumer Finance Protection
Mhm.
Bureau, and all of the loans that get originated, they're supposed to check out what is your debt to income, demographics of those loans. And I'm just going through some of those. I just pulled one from Loan Depot because I happened to witness what was going on
Yeah.
through them. And of their 2022 originations in Minnesota,
Mhm.
more than 50% of those originations, the debt to income levels are over 40%, which
Wow.
that's shocking to me. How is that, going to play out for people if,
Yeah.
let's say in this economic situation we're facing, right?
Mhm.
They lose their main source of income.
Yeah.
They take on gig work or they're working two jobs. Is it going to be the same enough to cover, you know, their debt payment? Um, so for selling, I think
Yeah.
there's multiple different avenues there. I
Mhm.
don't know that, we're going to get to the same level of GFC for selling, but I do think all the pressures are there in the current
Hmm.
economic situation based on the debt service coverage ratios that I've seen,
Okay.
some of the lending practice that I've witnessed over the last couple of years as well. But
So,
that all remains to be seen.
again, I want to go back to the ARM part of it. So again, the DTI, or debt service coverage ratio, again, not my area, yours.
Sure.
Do the loans that originated, like Loan Depot 2022 Minnesota, is it fair for an outsider like me to assume most of those are fixed?
Yeah, the majority of them would be fixed. If they are for new construction, there's a good chance that they're temp buy downs.
So
There's
like,
good,
1, 2, 1, 2, 3, 2, 1 or something.
correct. Yep.
But there
Three,
is
two,
a
one.
fixed number.
Correct. And I
Okay.
don't know, for your listeners, that would be where the first year of your loan, you're paying a reduced rate. The second
Yep.
year, slightly higher. Third year goes to your actual rate. So you're
And then stays there for 28 years or 7 years or
correct.
whatever.
Correct. So it's not an
But
arm. It's
and
just temp.
loans were underwritten to the higher number,
They should have been correct. I
or
mean,
they
that
should have
is
been.
the correct way to do it. Is you have to qualify at the higher.
Yeah.
Uh,
And
but
that was
then
a difference from '05 because they were underwritten to the lowest number.
correct.
That's
So
very
that is
different.
one of the things that is very different from GFC, pre-GFC to now.
Yeah. So yeah, I want to again. I saw again. So you don't know my story. So I buy a house in Fresno, California. I just call it Norris Drive. My audience knows it. In '01 for 107 grand. I
Sure.
end up selling it in '05 for 265. So I saw crazy appreciation,
Yes.
right? It goes all the way to 300, right? So I sold a little early. It then retrades at 75. So my market goes from 300 to 75 in about 3.5 years, right? It
Crazy.
starts slowly and then goes all at once. So I saw it up close and I have endless amount of stories like that.
Yeah.
So what I saw happening was, you're absolutely right. The pain really started kind of in '07 with you started to see some distress, right? It's still kind of limping along
Yeah.
sideways. You started to see inventory pick up. You started to see, some price reductions. Um, but it wasn't until those neg am, those nasty neg am loans, pick a payment loans started blowing up, which seemed to start really maturing in '08. They originated in '06. They had a 2-year term. They started blowing up where people just gave up. And that once that hit, it was just a race to the bottom.
Yeah.
Um,
Absolutely. And then unemployment increased in '08, and that really sped things up.
yeah,
And
exactly.
prior to '08, so late '06 into '07, it was subprime.
Yeah, that was
But
the kindling, but then it was Alt A that came on top that just blew it
right.
up.
And then it was super prime. In fact,
Oh,
more
super
than
prime. I don't know
yeah,
about this.
more than 500,000. There was a 500,000 more prime borrowers that defaulted in '08 through '12 than
Hmm.
all of the subprime. So it wasn't just a subprime
Oh, that
credit.
that was what was called. What was that called? Strategic default. Was that what that was called?
I think a lot of that has been called strategic default. Uh,
Yeah. They're
and
looking
then
at their house, they're
I'm
looking
sure
at their
that,
payment, they're like, here's the keys.
yeah, and there was definitely some of that,
Yeah.
but really, residential real estate suffered all the way into 2012,
Oh,
2013.
for sure. I mean, depending on where you are in the country, I always talk
Right.
about in my market, 2010 was the best year to be a buyer,
Sure,
and
sure.
but some markets 12, and that's
Right.
because Wall Street started coming in, right? These big deep pockets just buying everything. It was
Right.
wild to watch. Um, I do want to talk about one thing that I think would be remarkably different if we start going down this slope of pain in residential today or in the
Sure.
very near future. I think we learned during the pandemic that banks are going to react entirely different this time, at least in my opinion. Last time, banks would not talk to you until you were 90 days late.
Yeah.
If you got 90 days late, I think the odds were like 95% you would have a short sale or a foreclosure. You just didn't make it up.
Sure.
What we saw in the pandemic is forbearance with a click of a mouse.
Yes,
Like,
we did.
it was like, just click this button and you got 90 days or 6 months or whatever.
Right.
Um, Maybe that was a pandemic thing and maybe that's not coming back. But my impression is if we ever get in a slippery slope again, banks will react differently. But maybe I'm wrong.
Yeah, it's hard to say. We still have a lot of, uh, you know, restraints on foreclosure right now. Most certainly through things like FHA, VA, but there's different state, regulations that have been enacted post-pandemic as well. So I think one of the reasons why we don't see more stress right now is those forbearance programs in effect. And
Mm,
I think banks are probably looking at all types of different ways to prevent that from as well. So that,
yeah.
if there's a way that they can extend it or modify the loan and not deal with the loss, obviously, why would they, right? If they're in the business to make money, not to lose money.
Yeah,
So
that's it. They don't
if,
want
if
to
they,
they don't want to repeat of last time. That was very
yeah.
painful for banks.
So if they have to modify that, I'm sure that they will. It's a game of volume, right? I mean, if you're
Correct.
inundated, and that was one of the things that happened during the GFC as well. You had banks that were absolutely inundated. They couldn't have responded within 90 days, even if they wanted to.
No, because all they were it was back then it was phone calls.
Yeah.
It was
And
phone calls, not
and
the web.
there were people, I knew folks that they had been foreclosed on in '08, '09, but the banks, they just said, just don't leave.
Yeah,
Just
stay there.
wait until we
Yeah,
can deal with it. And there were people that were living in their homes for 2, 3 years.
I know
It had
them.
already
I know
been
some.
foreclosed on. They paid no, rent or
Nothing.
mortgage, but
They didn't pay property taxes. They didn't pay anything. Yeah.
right, and the banks couldn't do anything because they couldn't deal with it fast enough to get there. So,
Yeah. Well, so
Yeah,
let's
that
kind of
was crazy.
yeah, so let's kind of play this out because I'm always trying to pay attention because again frankly um there's opportunity in chaos, right?
Oh, absolutely.
And that's always where I'm trying to find opportunities to move capital around. And when I look at residential real estate and I try to look into the future, it's always a guess, right? Nobody's
Mhm.
crystal ball works. But one of the things that I think Ulysses, and again, please disagree with me, is a lot of people think unemployment's going to go up, as do I. Some
Sure,
people think it could spike to a crazy number. Let's call a crazy number 8%, almost a double.
sure,
If that happens, you're going to see a lot of people with these, 33 to 40% DTI numbers just not be able to pay
correct.
because they lost, one or both of their, income sources are gone. And when I look at that situation, and again, it will be a wave. It's not a trickle, right? Banks can
Right.
react to, one-offs. But if we suddenly see a spike in unemployment, my natural response is, okay, we're going to see a 6-month forbearance window come back in a
Yeah,
heartbeat. We're going to that's one of the things that I think. Now, if unemployment goes up slowly, I think it's a different story. But if we do get that sudden spike, like we did in the pandemic, where we went from 4 to 10,
yeah,
um, I think it's again in my world, it's like okay, I know how the banks are going to react to a sudden spike. What do you think of that?
yeah. I think if it's a big spike, we might. That's the problem that we're facing, right? We have uh, government. You can call it, moral hazard, whether they should or
Oh,
shouldn't
absolutely, yes.
step in. But we do know that every time an economic situation is bad, there's a
Mhm.
response. Whether it's the right response, whether it's a helpful response or harmful response, remains to be seen. I think you're right. If we go, if we hit 8% unemployment, uh, and for anybody out there at home, 8% unemployment is very high even for a recession.
Yes,
82, 81, 82, 10%. Now it's basically
yeah. That was the
that
worst
was,
since the Depression. 81 was
yeah.
the worst recession. Yeah, Depression.
And housing, had the disastrous effect all over the country as well. We didn't have, it wasn't like GFC where every city across the country, for the most part, felt it and had that. But everywhere, especially places that had manufacturing industry, they felt it was terrible. It was as bad as GFC for housing.
Yeah, in
Home
locals. Yeah.
builders, it was just so destructive.
Oh, crazy. I mean,
Home builders, was,
borrowing at 25%. Can you imagine a construction
yeah,
loan at 25%?
oh,
Crazy.
it's just unreal. So that was as bad. That was the last time that home builders had seen the consolidation that we had seen in GFC, where we had even more builders then, and the
Yeah.
industry consolidated down, and then post GFC
Mhm.
with even more price impairment. You know, there were people that just
Yeah. So
disappeared.
I've got a lot more topics for you, but let's kind of wrap this one up. So I think what I hear you saying for my audience out there and for me, there's actually a lot more similarities today in I'll call it the loan market, the origination market that with '06 than the average person thinks, right? The average person like myself who saw pickup payments, who once signed a blank loan application because the loan
Sure.
provider said, I got your file. I don't even know what that means, right? Whatever that means.
I haven't witnessed anything that bad, but
Yeah, it was
I
bad.
don't think that the lending standards are as great as what gets reported out there, right? I don't
Okay.
think
Yeah. So there's more fraud in the
marriage law
system.
solved everything.
Yeah, earlier we did a very simple math formula where we thought there was 5 million in originations, a million went away to investors, 4 million owner rock. I had assumed inside that there was 5 to 10% fraud. What I've heard you say is no, Michael, it's probably 2, 3, potentially 4x that. So that was eye
Right.
opening to me. Definitely something to watch. So next I want to talk about Jerome Powell.
Sure.
I think Jerome Powell has a really hard job. I have said for years now that he is trying to break what's often called the Fed put.
Yeah.
Past Fed presidents have had that moral hazard, has bent the knee to Wall Street. I think Jerome Powell's trying to kill the Fed put and be a standalone entity as they should. But curious what you think.
I would concur with you on that.
Oh, wow. Okay.
I
We actually
think,
agree for once.
yeah, I think the man takes his job seriously. Um, I think he's the first, we'll just put it, serious person in the position
Yeah.
in a long time. And I don't think that he has this, I don't think he has an easy job.
No, I
I
would
don't
not
know if
want
there's
that
enough
job.
money in the world to pay me that job. And
Mm-mm.
I can't imagine having to be in a situation where your be your behavior, your timing can have such a dramatic effect uh, on an entire nation or the world, really, because
The world,
you
yeah.
know, U.S. economy, right? We're not just on an island, literally,
No,
right?
no, we're the
The world's
reserve
reserve
currency of the
currency is
world.
the dollar.
Yeah.
So borrowing rates, the effect on unemployment are enormous.
Yeah.
Uh, yeah, he's got a terrible position. If he does the right thing, he's going to cause problems. If he does the wrong thing, he's going to cause problems. It's literally a no-win situation for him, even if he
Yeah.
does what's morally and altruistically the right thing to do in his job.
Yeah, one of the things that I've said about Jerome Powell is he's already richy rich, right? He's already got enough
Right.
money.
Yeah.
He's playing for legacy at this
Yeah.
point. He wants his name to be mentioned with the likes of Paul Volcker long after he wants to be in the history
Agreed.
books as the greatest Fed president or second greatest Fed president. That's what he's thinking about when he's making decisions. Again, wouldn't want
Sure.
his job. But something I did on my channel going into last Wednesday's rate decision is I actually had no idea what they were going to do. And my audience will know that that's crazy because I've made a prediction every cycle for years. But
Sure.
what I did say, Ulysses, is if the Fed gives us a quarter, they're
Hmm.
concerned about the US economy. If they give us a half, they're scared.
Yeah.
They gave us a half. In my opinion, that means they're scared, but I don't know what they're scared of because it could be banking, it could be unemployment, it could be the
Sure.
economy, it could be a whole long list of things. But what did you think of the 50 basis last Wednesday?
I would agree. And everybody over at Macro Edge had been calling for that they were going to do a 50 basis point cut. We call it
Nailed it. Nice work.
the jumbo cut. And we believe that it's mostly labor driven.
Okay.
We've all watched the labor market very closely for the last year, and we've been watching unemployment pick up steam. Uh, we hit the Cantrell rule,
Yep.
um,
The Psalm
5%.
rule. Yep.
Yep, the
Mhm.
Thumb rule, um, and labor just it keeps deteriorating, right? And we've heard
Yeah.
Powell talk about that, and we know that his focus is either on right inflation or
Or
labor.
labor. Yeah.
And now we're
There's
labor
victory
focused.
here. I'm concerned over here. Yeah.
Correct.
Yeah.
And
Yeah.
so if unemployment picks up, that's not bullish for the U.S. economy.
Oh,
That's the
not at all.
opposite.
Yeah.
And,
Yeah.
and not saying that it's not the end of the world. It's not the end of the country. It's not the end of the dollar. Not
Nothing. Yeah.
recession, right?
I mean, recessions are a natural
Natural.
part of the business cycle, folks. They're going to
Correct.
come.
Sure.
I hope you live through 3 or 4 recessions. That means you lived a
Yeah.
long life, right?
Right.
Let's be
Exactly.
real.
Exactly. And
Yeah.
hopefully everybody gets wiser through them. And
You get to be better and better. Yeah, yeah. So it's funny on this because unlike last week, which I didn't call, I actually called the next meeting really early. I feel like we're getting another 50 in November.
if we get 50, that would be a really big sign of concern.
Exactly.
I think what's being priced in it is another 50 total, a couple
Yeah,
of 25.
25,
But if we
25.
get,
Yeah.
yeah,
Yeah.
but if we get another 50, then yeah, it's probably because labor is deteriorating. One of the things that I track for Macro Edge is
Mhm.
in the loan markets, right? So uh, all of the mortgage asset transactions that transpire. So not just mortgage originations, but secondary market transactions, whether that's
Portfolio sales, right? You're selling a
right.
portfolio. Yeah.
And it's from everybody, from insurance companies to pension funds,
Yep.
uh, known business entities, right? Even non-financial corporate, not private equity because that's not tracked, but and I'll post a chart on Twitter so that you can share that as well. But basically, the amount of dollars has been contracting since
Hmm.
third quarter of 2022, and that to me is one of those signs of recession. I look at it like, okay, the actual dollar amounts of all these originations and secondary transactions is falling.
Okay.
That's one of the things that I think plays into that. The
Mm,
problem that we have with that data set is it gets reported backwards. So
right.
the data that we
It's,
have
yeah.
is through the second quarter of this
Oh,
year. So we don't
wow.
have third quarter,
Got it.
but it's broken down on, instead of the transactions, just the assets values.
Hmm.
So if they're seeing that that's plummeting as well, then that's something else that the Federal Reserve tracks. This, the Board of Governors, they have
For sure.
access to this information before we do with the public. So if you've got the mortgage market contracting as well as unemployment
Hmm.
increasing, natural recession
Yeah. I,
indicators, and both negatives for the economy overall.
yeah. Yeah, it's funny when talking about a recession. A stance that I've had for a while. Again, I have an econ degree, MBA, right? I've studied the consumer for 30 years. I actually think what we're in will be backdated is what's called a rolling recession.
Oh,
I think
sure,
this rolling recession could be 18 months to 2 years. I think there's a chance we're actually closer to the end than the beginning of what might be a rolling recession.
sure.
Um, it's not, I don't see this all like Wile E. Coyote over a cliff and everything falls. I don't see a
Yeah,
repeat of the GFC or the .com. A lot of people are acting like that's what's coming. I'm like, I don't think so. Look at the M2 money supply. Look,
uh, I think what you're describing to me is sort of natural recession, where this is the thing about recession, right? Even during the dot-com bust in 2001,
mhm.
even Mary Daly of the Federal Reserve was talking about whether or not we we were looking at recession, or if recession was going to come. And we were in recession.
Yeah,
And same thing.
yeah. If you were
Bernanke,
in tech like I was, it was obvious.
yeah.
It
And
was
then even
obvious.
Bernanke in 2008 talking about how the economy's fine.
Yeah, I
Well,
remember.
then we know we got backdated. No, we had been in a recession.
Yeah,
So, yeah, I think there's a good chance it does get backdated prior to where we are at now.
for sure.
Um, I think that there's a good chance. I've heard discussed last year. Daniel DiMartino Booth has talked
Yeah.
about third quarter of last year. I think that's
Yep.
possible. Um, I think it's possible that if we were backdating 2022, part of it does get declared recession. Maybe we came out and it's been like 80, 82, where
Right. Right.
still
There's two of them.
recession.
Yeah. Yeah.
Yeah.
Yeah.
I don't know if I'd say that we're closer to the end, but I think, and maybe this is how you view things as well.
Mhm.
It's usually when everybody else is saying that they're terrible,
Mm.
they're improving, and vice versa. When you're saying that they're getting worse, most people are going, "What are you talking about?"
Ah,
And
party
if you're
time.
looking
Yeah.
at the economic data,
Yeah.
um, so
Well, yeah. So
yeah,
I love this
interesting.
conversation. This is so fun for me. So one of the reasons I think rolling recession, and again, we've never had one, right? There's talk of in the economic books, they always talk about, I think
Yeah,
it was 84 or something like that, but we've never really had one. We certainly haven't had one that lasted years.
yeah,
So I'll just talk about mortgage because that's one of the things that I think
sure.
both of us have experience in. I think the mortgage industry has been in a depression,
I
all
would
out
agree with that.
depression, right?
Yeah,
Probably for 2 years,
yeah. Oh,
right?
absolutely.
One thing I said about 6 weeks ago or 8 weeks ago on my channel is I think we're about to see a refi boom. And
Mm,
again, if you look at the last 3 or 4 weeks, refinances, last week was up 175% or some stupid number like that.
sure.
Um, Again, these are comparing to very small numbers. You got to be really
Right.
careful with percentage.
Right. Like that
But
FHA chart I showed, where there's an
yeah,
enormous
exactly.
spike, but the amount is small. Right.
It's tiny, right?
Yeah.
Percentages could be very dangerous. And thank you again for the help with FHA.
Oh, of
Um,
course.
I think there's a chance that the mortgage industry, again, with rates coming down, and we'll talk about 2025 next. I don't think they're going as low as people think. But I do think there's a refi boom coming on. There's enough people that bought at 8% and 7.5%, so they're just going to do rate and
Sure.
term and come in. I think slightly lower rates will bring some marginal demand off the sidelines. So I think the mortgage industry that has been in contraction, all out contraction for 2 years, is slightly positive over the next 12 months.
Sure.
Maybe while travel, who was booming the last 2 years, I think travel will be in contraction because the consumers are
Sure.
broke, right? So when I look at the different segments of the economy, some have been in all-out depression, others have been booming, and I think we're starting to see some of those flip. So that's kind of why I put out this notion of rolling recession.
Sure. And I think that's kind of the interesting thing. That's almost always how the markets work, right? You've got some industries where they're the first ones to die off, and while they're going, we're in, to your point, we're in a depression here. Most people are going, it's just it's just
That's
you,
those
it's not
guys.
everybody
That's
else.
not me.
And then when everybody else is going, oh no, it's all of us. They're like, no, it's not us anymore.
Yeah. Yeah. Well, I don't know. I mean, certainly the average consumer doesn't, when they think recessions, they think Wile E. Coyote off a cliff and then just all or
Right.
nothing, right?
I
Um,
think that. Do you think that that's partially because of how they get reported through news, though, right? Where everything's rosy until all of a sudden it's not, and then when it's not, everything's terrible, everything's bad.
well, again, I think the last two recessions, excluding COVID, right? Because that was like 2 months. I think the last two recessions have distorted reality. I think the dot-com crisis was definitely an all or nothing
Sure,
kind of thing, and the GFC was such a unique, hopefully never to be repeated thing. I think there's a lot of recency bias. I don't think there's a lot of people that have studied 80, 81, 82. I don't think
sure,
there's a lot of people that have studied, 90, 91.
yeah,
Um, and again, I think the recession we're in now is going to be, it'll have the one of the longest durations. It could be
sure,
24 months. The average recession is 10.
right,
But I think the depth, by depth meaning GDP, when it's all cumulative,
hmm,
will be pretty shallow,
sure,
is what I currently think. So I think it's very different than the last two.
sure. Well, that's the kind of the interesting thing about each one of them. There's always a, you know, you say
Yeah.
history never repeats, it
But it
rhymes.
rhymes.
I think a
Yeah.
lot of it repeats, but there's always
Yeah.
a slightly different.
Yeah. Well, I want to
It's
get
like,
into rates because I want to talk about what scares me in 2025.
yeah,
I've seen a lot of people in the real estate industry. My email blew up after the Fed cut rates from unscrupulous mortgage providers talking about rates going lower. They did not. They went up. Um, at least mortgage rates went up.
yeah,
Um,
mortgage.
I think I think mortgage, again, when I talk mortgage, I talk 30-year owner occ, best
Yeah,
credit, because that, mortgage business daily kind of stuff.
sure,
I think there's a lot of people out there that are thinking mortgage rates will be sub 5% in 2025 because, hey, the Fed's going to cut 200 basis points and all of that. I think they're grossly inaccurate. I think what most people are missing is the last 2 years have had a inverted yield curve. I think the yield curve going forward steepens versus inverts.
sure.
And I don't see mortgage rates in 2025 going much below 5.8, even if we
Sure.
get a couple hundred basis points. I'd love to get your thoughts again, wild ass guess about rates in 2025.
Yeah, I could see that being very real. Um, Unlike popular belief, Federal Reserve, federal funds rate doesn't affect directly mortgage rates.
No.
Um,
Yeah.
if long-term treasuries stay elevated from where they have been,
Mhm.
then yeah, mortgage rates are going to be 200 to 300 basis points, as they say, above that, right? Because
Yeah.
that's how those rates have always been set. It's based on yield above
Yeah,
the treasury.
yeah, one of the things that's really interesting to me, again, when you go back and look at decades,
Mhm.
the historical spread between the 10-year and mortgage is about 180 basis points. In the
Sure.
latest cycle, I think we got as high as 308 basis points. I think today it's about 260,
Yeah,
265.
that sounds about right. And 2.5.
Yeah, somewhere in there. Um, so one of the things that I think will help mortgage rates come in a little bit is just natural compression of that. Right.
Sure.
I don't think we'll stay at this elevated yield level. I think banks for a long time were uncertain where the Fed was going and when rate cuts would come. I think there's clear certainty now that a rate cutting cycle has started and will continue. So I don't think it's unrealistic to think that, let's call it 265,
Mhm.
comes into maybe two and a quarter over
Sure.
the year. But
Right.
I don't think it's going back to 180 in 2025.
I would agree with that. I don't think that we're one of the things I think people forget is like the 50-year average of rates are seven and a half,
Something
7 and 3/4.
7 and 8, something like that. Yeah, yeah,
Yeah,
somewhere in
so
there.
even at 5.5, that's still historically below average, or 5.8. That's
Yeah,
not a
not
bad rate
horrible. Yeah,
at all. I mean, my first house, I think I bought, it was 8.25, and
yeah,
I refinanced at 7, and I was ecstatic, about
yeah. I remember.
getting back out of that. And that's
Yeah,
one thing that's just been forgotten over the last mostly 10 years, where
yeah,
with zero interest rate policy and treasuries yielding the lowest they were, then
yeah,
mortgage rates followed.
yeah. So let's talk about what I want to talk about what scares me in 2025. I think there's a couple of things that scare me that I want to share with you to get just your natural reaction.
Sure.
Since we're talking about interest rates, we'll go there first. I will tell you that I think, 5.8 to 6.2,
Mhm.
2025. I feel good about it. The housing market will stay slow. We'll still do 4 million transactions. The move up buyer is still out of the market, all of those
Right.
things. But the market behaves kind of where we are now, in my opinion.
Sure.
I am afraid that for some reason, maybe the Fed buys mortgage-backed securities again.
Please no.
Maybe, believe me, I don't want that. I'm just saying things could happen
Yeah.
where the 30-year mortgage rate has a 4 handle on it, 4.8, 4.9. I'm
Sure.
not calling it. I'm telling you, I'm afraid of it.
Sure.
I think if we go to a 4.9, that will send the housing market crazy again because I think a
Mm,
4.9 brings the move up buyer off the sideline.
mm,
So we get a lot more inventory, but we also get a lot more transactions and the real estate market gets unhealthy again,
sure.
in my opinion. So that's the first thing I'm afraid of is anything with a 4 handle.
I can understand that. I think one of the things that um, maybe to help alleviate your fears is if unemployment continues to go up, then I don't think the under five rate's going to have the same effect as it has when unemployment is going down.
True.
And that's one of the things that we saw post 2020, right? Unemployment spiked,
Yeah, but remember these
but then
small
as it came
numbers.
down,
Yeah, let's just say unemployment goes to 5.5, a much more
mhm,
realistic number than 8.
sure.
That's, I don't know, 3 million more unemployed. It's
Mhm,
horrific, all of that. But there's this old saying that the difference between a recession and a depression, right? A
mhm.
recession is when your neighbor's laid off, a depression is when you're laid off,
Yeah, right.
right? Exactly. Because the thing that I've been seeing lately is the marginal demand buildup. You and I
Mhm.
are about the same age, and when we were kids, we played with the water hose. Remember when you put your thumb on the water hose
Yep.
and the pressure built up?
Mhm.
Even if we have unemployment rate jump to 5.5%, which is possible, I think there's still 94.5% unemployed, a large percentage of folks that have been this marginal supply because there's been no first time homes. And we're coming from a small number, right? The base is small.
Mhm.
I think the impact will be a little more than maybe you think.
It's possible. Obviously, don't have
Yeah, we're
a
just guessing.
crystal ball. I can understand the concern because I think one of the things that you probably fear in that is that we see more housing inflation, which
Correct.
is
That's
not
the big
positive.
fear. I don't want it. No, no more. Let's go another 4 or 5 years flat. Let's just be flat.
Stable, some stability after the
Yeah,
last 4 years.
that's
Yeah,
that's all I want. I do not want the market to jump 10 or 12% because at
yeah,
that point, I will be selling everything. I
yeah.
don't want to do that.
It's
I just want
abnormal
flat.
too, right?
Oh, it's horrible.
Those are the things where we do see those big Fed reactions, where you go, okay, there's 2 years of 2 to 3 times what the average
Yep.
inflation rate in home value, and
Yeah.
then we have consequences as a nation.
Yeah.
I, Builders right now, they're offering sub 5%,
Yeah.
uh,
They have figured out where home buyers are. There's
and
no
they are
doubt.
still struggling. One of the things that I've created a index composite, so it's a
Hmm.
four-part weighted composite index that I call the U.S. Property Services Home Building Situation Index,
Hmm.
and it measures the sales rate, the amount of inventory, the mortgage rate change, and the price direction, right? So if price is expanding or contracting, they're impaired. And sales, while they're slightly better than average, it's not enough to, what they're doing is they're building inventory
Yep.
and starting to build even more. And so that's why, that is the biggest negative component of the index right now, showing that we're at 2007 lows in home building
Wow.
because we're building inventory.
Yeah, they're slowing
Despite
down. Yep.
sales doing okay, they're not doing what they were when they started planning all this inventory. So it's
They're
definitely
managing their cash flow.
correct. And
Yep.
they're going to have to
Yep.
slow that down even more so that they're not sitting on all that inventory and
Yeah,
instead of
we'll
having
see.
more price impairment.
Yeah, one of the things that I've said is I think Q4, really the last 4 months. I said this in early September, maybe even late August. I think the buyers are on revolt. I think this election, I think the consumer, right? Because I've studied the consumer for 30 years.
Yeah,
The consumer has the ability to pull back for 6 months. I'm
sure.
scared, I'm afraid, I'm concerned, blah, blah, blah.
Yeah,
Contract. We get past the election. It's a known outcome. They haven't lost their job. Their neighbor
right.
did. Consumer, our consumer-based economy, they don't pull back for more than 6 months. So it'll be very
Sure.
interesting to watch the spring selling season for both
Yeah,
new home and pending. Was there
agreed.
really pent-up demand? But
Yeah,
let me
I
tell you
think
about the last thing I'm afraid of because we're running out of
sure.
time. My biggest fear, absolute biggest fear for 25 and 26 is government intervention. What do I mean? If they create some stupid $10,000, $15,000, $20,000 down payment assistance free money, that is going to distort the market like it always does. It's going to cause artificial and very quick and sudden appreciation. And it is the last thing I want in the housing market. That is my biggest fear, even over a 4.9% interest rate. What do you think of
That's
that?
completely understandable. I think depending on when and how they go about it will make a difference in the effect it has, right? Like if they did that right now, to your point, the psychological position that the American consumer is in right now, I don't think it
No,
has any effect right now. I think it would
no,
be akin to '07 where they first time home credit that
yeah,
didn't help. And
no,
new home building continued to tank for
yeah,
3 more years, um, 4 more years from '07. So depending on when, yeah, and that is one of the other problems is government intervention.
yeah.
And we saw that in that even in the '80s too, right? We created mortgage-backed securities and legalized them. We
We
created
sure
the
did.
adjustable rate mortgage in order to spur it on. And so that's part of the reason why we got out of the '82 recession, is because of intervention. Depending on
Yeah,
what intervention they take, yeah, I would agree with you because it's only going to,
yeah.
depending
So
on
when you,
when and to what
yeah,
measure, it can
when and
have a
how it,
catastrophic
right.
effect for
Yeah.
housing prices. Correct.
Yeah, there's a chance they put so many caveats in all of this, it's a nothing burger. But again, when I look at what could distort the housing market, because again, as I said
Sure.
earlier, I just want years of flat.
Yeah.
It would be free money. You bring in
Yeah.
low rates plus free money,
Agreed.
my head
That's
explodes.
just usually a recipe for disaster.
Yeah, it'll feel good for a moment, but it will not end well.
Yeah.
See Great
Right.
Recession for outcome. So those are two things I'm afraid of. When you look at the kind of kindling or under the surface things going on, what's one or two things that, again, you're not calling, but you're
Yeah.
like, hey,
Sure.
this could be scary.
Uh, One of the things that I guess I'm most concerned about in my industry is more consolidation in home building.
Ooh,
Right. I think it's better for the economy. It's better for the country when we have more smaller businesses.
I agree.
And whether those are, small one or two man businesses, or one or two people businesses,
Yeah,
or
infill
just
lot
50 to 100
guys.
employees,
Yeah,
right?
yeah,
It's what makes the country go around, and I think it's what makes it a better place.
agreed.
And if we get more consolidation, and then D.R. Horton, Lennar, and Pulte become 80% of the housing market,
Yeah,
that's
not good.
terrible. And I don't want to see that. So,
I like that. You got another one that under their like anything about this more fraud that I expected or
uh,
estimated? Anything you
yeah,
think lights that up?
it's the more of that comes to market, and then we find out that it's worse than all of us thought, and
Oh
things go
no.
backwards again. Uh,
Okay.
it, you know, uh, I don't know. I think it has the potential for that. Um, and again, that's
Yeah.
going to just expound the unemployment situation, and then you get more consolidation in the wrong spots. So those are my biggest concerns, and then the wrong government intervention, right?
Yeah. Ulysses, you're amazing, man. Thank you for doing what you're doing. Nearly 30 years of experience in the quagmire of real estate before, during, after. I appreciate you. Thank you for highlighting where I may be wrong or off. Thank you for being kind on X. Not a lot of people
Oh,
are kind on X or Twitter. You were very gracious in highlighting the facts and also telling me the bigger picture. So thank you for being so kind. Where can people follow you?
yeah, you can follow my writings at macroedge.net. You can get a 2 weeks free trial to the entire Ozone subscription package and get more than just my real estate analysis. You can go to my website, uspropertyservices.com. And you can subscribe to the Home Building Situation Index and get that updated every month with the survey of construction, or on Twitter X as at Mr. Awesome. That's AWSUMB, which
Love
is
that.
my real last name. So
There you go. Ulysses, you're amazing, man. Thank you for being a friend. Thank you for becoming a channel. I'll have to have you back.
yeah, thank you very much, Michael. It's been a pleasure.
You got it.